All righty. All righty. Welcome, welcome, welcome. Welcome. Welcome, welcome, welcome. Oh, what's going on here? Oh, there it is. Welcome, guys. Welcome. Didn't mean to do that. Welcome. Hello, everybody. Hello. Just trying to say hello to everybody before we get started. Pretty exciting day today. I got some really exciting stuff to go over. So I'm just going to give people a few minutes to kind of join in. But that's where we're at. So let me move up a little bit, get a little closer here. Get you guys to zoom in on me. All right, so welcome, welcome, welcome. This is Professor Milligan, Wall Street Wednesday. A lot of exciting stuff going on. So I'm just trying to get this thing, zoom in a little closer so you guys can really see me and see what's going on. And I think that's pretty close enough. I'm right up in the screen. All right, so today is what? Today is December 9th. This is Wall Street Wednesday. Pretty exciting day on the street in terms of some of these IPOs and what's happening in the marketplace. So I'm going to dig into it. Just to let you know, I got a little housekeeping. I've gotten a number of emails from former students, from people that will listen to the call. And the good news is you guys are making money using some of the strategies I'm talking about, which is a wonderful thing. So keep doing that. Keep telling me the good stories. Keep putting money in your pocket. That's what this is all about. All right. So let me get started. The question I've been getting all for this whole week, which we're only on Wednesday, but this week as well as today, is what to do with DoorDash and what to do with these hot IPOs. All right. So they're asking me, would I buy, where I'm buying at, would I get in now, what am I going to do? So let me give you a little bit of information. First and foremost, the IPO market, and again, I apologize, it might seem like I'm pulling you back, but I got to go through this. When it comes to the IPO market, the way that they determine where the stock price is going to open, whether it was like what they did with DoorDash, which was this hybrid auction, but typically they build a book. And what that means is the institutional investors contact the investment banker, the investment banker contacts them, and they tell them how many shares they want to buy and what price they want to pay for it. During this time that they're doing all this, the senior management and the investment bankers are out pounding the street, telling everyone the good news about the company. All right. Now I got to go a step further. What happens after this, believe it or not, and I'm going to show some examples, but the public gets behind the company. And when I mean public, I'm talking about mom and pop. And all you hear from mom and pop is, I got to buy this stock. I'm going to buy this stock. As soon as it opens, I'm going to buy it. I'm going to get in it. And what happens is you have all this hype in the stock. And the challenge that you're going to come across is, which I've come across is, in most cases, the stock doesn't live up to the hype. All right, it just doesn't live up to the hype. And it's not that these aren't good companies. It just means that the stock got way ahead of itself. So as I was listening to the call today, and I got some texts from some of my former students, Professor Milligan, they're valuing this thing at something like $60 billion. This thing is valued, it's not worth $60 billion, Professor. What's going on now is the hype that's coming in from the marketplace, from investors. So with that said, let me go through some charts I put up here for you and let you visually see what some of the things I'm talking about. All right, so let me pull up some charts in no distinct order. So hopefully, and I'll talk about it. So what you're looking at now in this one is Facebook. Now, many of you might not have been trading, but I traded Facebook. And for me, the thing that was beautiful about Facebook was I made money on the short side. So I actually shorted Facebook on the IPO. And the reason being is I thought there was too much hype in the stock. I thought it was hyped up. I thought that investors were bidding it up on the opening. I can't explain to you how, as I'm traveling around in my normal daily life, how many people that knew that I was actively involved in the market said, Mike, I'm buying Facebook on the open. Mike, I'm buying Facebook. Facebook's the greatest company you've ever seen. I'm buying Facebook. I'm buying Facebook. And the whole time that happened, I kept saying there's no way the company can live up to the hype. So as you can see by this chart, Facebook opened up, I believe, as high as something like $45, $50 a share. You can see that within the second day of trading, it broke down to the 32. It broke it. It tried to rally back, and then from 32, it went down to below $20 a share. So that was Facebook. Again, don't get me wrong. Now, it took Facebook several months to work its way back up through that 32, but as you guys know, it worked through that 32 and moved on to go on to record highs and be one of the most touted, popular, wealth-making stocks that we've seen in the last 10, 20 years. Now, this one you're looking at is LYFT. Same thing. Now, the reason why I chose LYFT is because LYFT became public before Uber. LYFT was priced at $72 a share, and within that first day of trading, you can see the stock was as high as, I believe, somewhere in the 90s. I can't read my own chart. I'm not trying to read it. You can read it yourself. So you can see what happened. The stock was priced up here, at 72, ran up into the 90s, and then from there, what happened? The stock sold off. It pulled back down below that 72. It tried to rally, and you can see that at one point within several months, the stock traded as low as down below $20 a share. I am not saying that DoorDash or Airbnb is going to follow the same lead. I'm just telling you that when an individual investor gets behind these stocks and starts pushing hard, I got to own it. It's the best thing. I got to own it. The stock can get ahead of itself. And when it gets ahead of itself, it takes time to work its way out. Here's another example. This is Lemonade. Now, many of you might not remember Lemonade. Lemonade went public at $29 a share, and within 2 days, Lemonade traded up to $100 a share. As you can see, Lemonade pulled back from that $100 a share and proceeded to take several months before it finally, and that just recently happened this week, finally broke through the old high that was set several months earlier. Sometimes these things can run up so fast ahead of what's going on that they have to have a consolidation pull back and catch their breath. So so I'm reading now. So the profits of these, what would you put a sell order in? Here's the deal, and I'll say it quickly. If you got IPO stock, which most of us didn't, but if you got IPO stock in DoorDash, first and foremost, sell it on the opening. Just sell it and take the print. All right? Then come back in and look to trade it. Now, most of you, and the reason why you're on my call in the first place, and the reason why I developed this strategy is most of us did not get deal stock. Doesn't mean that this isn't a great company. It just means that we didn't get deal stock. So we don't have the advantage of getting a stock that was priced at, priced at 102, and it opens up and goes as high as 195. We weren't lucky enough to get that. It's a no-brainer. But from here, we got to figure it out. All right, that is, again, you're looking at Lemonade, insurance company. Tremendous company doing extremely well. The numbers are there. You can just see how the stock got ahead of itself. Now, the next one is Snapchat. Now, what's interesting with me about Snapchat is this. Going back to when Snapchat was going public, several of my students in class and I put together what we call a report. That report was what to do with the IPO stock if you got some. We had I had a student of mine, former student, who actually had got deal stock and was saying, what should we do with the deal stock? So, again, Snapchat. The hype was unbelievable. Snapchat was priced at $17 a share. The first day it opened up somewhere in the mid-20s, ran up to the high 20s. And you can see that pulled back and traded between 20 and 22 for a couple of days. And then it broke that 17 price. And then from there, Snapchat went down as below $17.50, down as low as $5 a share. Now, Snapchat has rallied back. It's doing well. It's actually at all-time highs. But again, it took Snapchat almost 2-3 years to work its way back up through that. The point I'm trying to make here is that the hype in these stocks can sometimes be so much that it can't live up to the hype and it needs to digest it and move back. And that's what I'm showing you. All right, let's see who that was. Snapchat. And this is Snowflake. Now, you guys know from the time Snowflake went public, the first thing I said to you guys is, well, we got to see where the first 2 or 3 days opening high was, which was 319. At that point, I told you guys, which I'm saying again, for me, the buy is going to be back in the move back through 319. If the stock moves back through 319, I told you guys I'd buy it, and I felt like it would challenge 400. Well, 2 things. 1, it took several weeks, but the stock did break through 319. 2, when it broke through 319, the stock has run up to over $400 a share. Excuse me. Now, it's doing some backing and filling now, which is okay, but this is what happens. This is what these things do. Now, let me pull up, and I know I'm going from chart to chart, and I apologize for that, but I'm excited. And this was taken an hour before the close, and what you're looking at is a 15-minute chart on DoorDash. And you can see how the stock opened, it ran, and then it pulled back and consolidated. It was in a trading range. Now, the last half hour of the day, the last hour of the market, which is always the way it works, they pushed this thing and they rallied it and ended up closing at 189.92. So I'm going to wait. I'm going to watch. I know a couple of my students asked me if this was a short up here. And the thing I'm going to tell you is, 1, I do think the stock's going to pull back. I think it's going to pull back. I think it's going to pull down. I think it's healthy. The near-term number for you is I would expect the stock to test this 164, 163 where it opened up, and maybe even go a little lower. But I would expect it to test that 163 number and maybe even go a little lower. So the short answer is, for those aggressive traders, yeah, I'd be looking to short the stock. Now, the challenge you're going to have is two things. 1, is there stock available too short? Can you actually even find the stock too short? 2 is options. The earliest options can become available in the IPOs within 5 business days. So the options aren't there yet. Now, there are some special situations where you'll see options trade the same day, but I checked, there are no options on this. You're probably going to see the options available within 5 days. So 5 days from now, 4 to 5 days from now, you'll see options available. So then maybe you can play the puts. But again, the challenge you're going to have is getting short. I am going to wait for this thing to consolidate, fill. Right now, the number that interests me is the 195 number. So I would get excited on this thing on a move through 195, but I think you're going to see a challenge of the 164 level before you see the 195. That's just, again, my opinion. That's how I would trade this. I'm sitting back and I'm watching and I'm waiting. Again, and I'm going to go back just so you can see it real quick again. I believe that's it. I'm just putting up Snowflake again, and the reason why I'm putting up Snowflake is, again, I'm waiting and watching. My belief is that the chart pattern or the price pattern you're going to see on DoorDash is going to be more like what you're seeing right here on Snowflake. I don't think you're going to see this thing run right now. I think it's going to have to pull back, digest. The volume was somewhat light for a hot IPO. They offered 22 million shares. They didn't trade 22 million shares. I'm looking right now at the volume. Okay, so volume it traded 100%. So volume ended up getting there the last hour. So it ended up trading 25 million shares on the 22 million share offering. So that's a good sign. But also what it shows is a lot of mom and pop activity. And then the other chart I want to show you real quick before I hop off. Let's see, I just showed you that one. I want to show you this one. This stock is, make sure I get the name right, C3A1. They're an artificial intelligence company. They were priced at $42 a share today, opened up somewhere close to 100. Believe it or not, I like this one. I like it a lot. It's trading sideways. This is, by the way, this is another 15-minute chart intraday. So you can see the trading range looks like it's below, between the low 90s, high 80s, low 90s, and about 100, 100 and change, 105, around there. But you can see that it's in that narrow trading range. Again, I'm going to wait to see what happens. I do not buy any IPO on the opening. I'm firmly against that. And the reason why, I'm coming out of this, and I'll tell you in a minute. The reason why I'm firmly against it, I'm gonna pick a chart. I'm just randomly. Who am I pulling up here? I don't even know what chart that is. Who's this? All right, this is LMND. The reason why I'm firmly against buying any IPO on the opening is because they can and do run, and if they run and then they pull back and consolidate after that first day, that first push and open of everyone saying, I got to own the stock, they typically pull back and consolidate. You could be sitting in this stock for several weeks, several months, just waiting to break even. Alibaba, priced at somewhere like 85, opened up, ran to 120 the first 2 or 3 weeks of trading, and then it broke below that 120, and it took literally 2, almost 3 years to work its way back up through that 120 high that it got the first 2 or 3 weeks of trading. So my only point saying to you this, guys, is that these things can and do get ahead of themselves. Be patient with them. All right. Now, I don't have a chart on this one. I thought I had it. I keep looking for it. Let me switch up. No, I don't have it, so I do apologize. But I am going to talk about it. I'm just looking to make sure I don't have the chart, and I don't have the chart up here. I thought I did. I just did basically artificial intelligence, and I also did DoorDash. The other one, I'm gonna type the symbol up for you. So let me do that. Let me type the symbol up for you. And another stock that I'm watching very closely. I'm very interested in it. Geez, eventually I'm going to get to me being able to type in here. Come on. All right. Can't get it to type. So the symbol is SEER. Symbol again is SEER. So I'm actually putting up on my chart right now to see where it closed at. And I'm switching to a daily chart, so bear with me 1 second. All right, this stock, I'm not sure. I don't remember where it was priced at. I've been watching for the last 3 or 4 days. 4 days. Today's the 4th day of trading. Stock has traded extremely well. Opened up at 48, ran to 56. Today went as high as 72 and pulled back to 66. The reason why I have not purchased the stock yet is because the stock has not pulled back and consolidated from the IPO. So there's been heavy buying. Now, what made this interesting, and one of the things I look at, which we talked about, one of the things I talk about when I talk about a hot IPO, DoorDash did it, C3A1 did it, Sears did it, SEER did it. And that is that the insiders, the private equity guys, the hedge funds, the VCs, have not sold any of their stock in the offering. Let me say it again. These companies just went public. It's a time that a lot of people who own stock can actually cash out and sell their stock on the offering. Then if they don't, they have an insider trading rule, which means they have to lock into it. But they could have sold stock in the offering, and yet none of them sold any stock. These stocks are trading at their all-time highs. They all opened and went to their highs, and the insiders have not sold any stock yet. So when's that happen? 3 to 6 months from now, they're going to start doing secondary offering, a seasoned offering and secondary offering, laying off stock. That's when you're going to see the insiders start to come out of these stocks. What that's telling you is, and I'm a firm believer in this, a lot of people on Wall Street think it's a disagreement. A lot of people on Wall Street think that these deals are mispriced. And I'm going, if you're the owner of the company, they're not mispriced. If you have insider stock and you're not selling on the deal, it's not mispriced. Just think about this. All these stocks are getting nothing but positive publicity. People saying, I wish I owned it. Look how much money was made. When they come back to the marketplace with a secondary, the market's going to have a much more friendly appetite and want to own the stock. It was not mispriced. And when the insiders finally do decide to sell, they're going to sell into an up market. They're going to sell when these stocks are significantly higher than where they're at now. That's why we follow the philosophy that we follow. That's why I do it the way I do it. Now with SEER, S-E-E-R, what was really interesting is this. They, in the offering, I think they raised something like $130, $140 million. The institutional insiders, the VCs, the mutual funds that own insider stock already, during the offering, they did a private placement and they brought another $135 million of stock at the offering price. All right, these are the insiders. Not only did they not sell any stock, make sure you understand what I'm saying. Not only did they not sell any stock, all right, and the stock came public and it's running, they brought more stock and it's private placement. So they doubled up on their positions. It doesn't get any more bullish than that, guys. It might show some short-term pullbacks here and there. It might show some moves because of the marketplace. But trust me on this. None of these insiders are buying the stock to flip it out plus 10, 20, 30 points. They're not doing that. All right, they're buying this because they truly believe that they can sell this stock down the road 6 months, a year later at significantly higher price. And I wouldn't be surprised if they do a seasoned offering, a secondary. I would look again to see if the insiders are actually selling stock and how much. So this is one I'm watching. I'm waiting. I don't know exactly when. Let me repeat myself. I don't know exactly when, but understand this. I will be buying this stock. I'm looking for my entry point. I don't know if the stock's way ahead of itself. I don't think the stock's way ahead of itself because a lot of people on the street would not pound the table on this. So a lot of individual investors, mom and pops, don't know about this company. So I think that's going to give us opportunity. I don't think the stock's going to pull back significantly. I think it's going to have a slight pullback and then it's going to run from there. All right, I'm getting out of breath here. I am excited though. So I just want you guys to get all this. Now, one of the things that I do is I go look at these companies and I look inside the prospectus and I want to see what their business is, what their business model is, one, what they plan on doing with the proceeds from the offering. All right, how are they doing it? Now, some companies that are coming, like the one coming public tomorrow, Airbnb, my big issue with Airbnb is the amount of debt that they're carrying. So I got to take a good hard look at that company. I'm not sure what it's going to do. One, there is hype behind it. Now, the other thing I'm going to say to you is that several of the other IPO tech stocks pulled back today. Part of that pullback could come from the NASDAQ market. NASDAQ took a hit today. It didn't fall through. There was not a lot of follow through in NASDAQ today. It went to a new high, then it pulled back. But the thing I'm looking at is this, and the thing I want to explain is this. A lot of these institutional investors that are trading these IPOs, they don't have unlimited capital. And what it will force them to do in some cases is they're going to be forced to liquidate some other IPO stocks that they've owned or they have to actually get the money together to actually trade the newer issue that's come out. So part of this pullback is nothing more than profit taking in some of these IPOs that came out recently. We've had a nice run. Profit taking, NASDAQ showing some weakness off its all-time high. And again, I got to emphasize this. I apologize for jumping, but you have to get rid of that mentality that just because something's at an all-time high, it's a short. Just because something's going to an all-time high does not mean it's a short. You got to get rid of that mentality. It's not always that way. All right, I just lost that, no problem. The other thing I'm going to say is this, is that These traders don't have unlimited capital. They have limited, so they move around. And then the individual traders, people like us, we definitely have a limited amount of capital, and you'll see us hop around and so forth and so on. All right. I am excited. I think, the guys, that there's still some money to be made in the IPO market. This strategy will work. Be patient with it. I'm telling you to be patient with it. I promise you I will let you know when I do make my next move. I'm watching. I showed you what I'm watching. So case in point again, stocks on my watch list that I'm really into. Now, don't get me wrong. I have if I ever showed you my watch list for IPO stocks and deals, there's about 40 stocks on there right now. I can name a couple of that have set new highs just recently. So understand this. In my IPO strategy that I use, just because an IPO has gone to a new high does not mean I'm going to trade it. There's other criteria I look for. And one of the criteria I look for is I look for small, medium, or large cap stocks. But I typically like the medium to large cap. I don't like the micro caps, the ones that are under 1 billion. I don't like the really small deals. Not that the small deals don't work, is that the small deals can really be influenced by the investment banker because they typically don't have much volume behind them, much float and much volume. So I like the bigger deals. I do like the bigger deals. I also typically like a certain core of investment bankers. I like the top tier core, the Goldman Sachs, the Merrill Lynch, the Morgan Stanley, the Barclays Bank. I like the top tier. I do not typically like to trade IPOs that were brought to marketplace by the smaller investment bankers. I'm not saying that they don't work. I'm saying that the securities that don't work are the ones that give you the bigger risk. Now, before I go any further, and I brought it up again when I talked about DoorDash, and I said to you guys, you can short, I'm being honest now. If you're an aggressive trader, I don't see any problem with shorting DoorDash up here. Now, understand what I just said. You're looking at me saying, Professor Milligan, you're talking about shorting a stock that virtually came public the first day and went to 195 and closed at 190, and you're talking about shorting the stock? For my aggressive traders who understand the risk, I would say short the stock here, put a buy loss limit right above the 195, right where the old high is. So the old high is 195 and change. I put a buy loss at 196. So you're basically talking about from here 6 or 7 points. And you could actually even see that tomorrow. So we'll have to see how it opens tomorrow. But I do think the stock will test the 164 number, which was a low today. And I also think that the stock might even break the 164. Don't get me wrong. I'm not saying it's not a quality company. I'm not saying that the stock can't go to 200, 300 from here. I'm talking about in the IPO process that people have bid the stock up so much off the hype. Can it live up to the hype? Now, if you watch any financial channels, they said DoorDash, and here's what's interesting. DoorDash at this price level has a higher valuation than Chipotle and several of the other companies that they deliver food for. It was funny, the guy on one of the financial channels was just talking about it. Understand, you're saying that DoorDash is worth more, which is the delivery company, worth more than the companies whose products they're actually delivering. All right? I could be wrong. I'm not getting into that whole conversation about what it's actually worth, because investors will bid up whatever they think it's worth. All I'm saying to you is that stock could be way, way overvalued right now. Yeah, Christian, you heard that too. It's crazy when you think about it. It's just crazy. But we've seen that happen with some other IPO stocks, that they actually valued more than some traditional companies. And again, it's because Wall Street is forward-looking. Wall Street's looking forward and saying what we think this company could generate in terms of revenue and growth in the future. So that's what Wall Street's doing. But again, for those who are aggressive, yeah, I'd short it. And like I said, you get to that 164, 163 number, you break that, I'd probably cover down there, pick up a quick 20 to 30 points and go about my business. The biggest challenge you're going to find, again, in shorting IPO stocks is finding stock to borrow. So you can contact your broker and ask your broker if there's any stock to borrow, but I don't think you'll find any stock to borrow. You should see options in 5 business days. So options should be trading by sometime by next Monday or Tuesday next week. You might be able to find some options, which means you can buy the puts. So what you're seeing now, I'm not sure if you're seeing this, but Christian's up here, and Christian's typing that one of the things he did was he went and looked at one of their closest competitors. Delivery Heroes one, another one is Grubhub, which is out there. A little different business model, but Grubhub's out there. So you can look at some of these companies and get an idea of how they're going to trade and what they're going to do. And then speaking of Grubhub, really interesting story about Grubhub. Again, one of my former students and I sat down. He put a buy recommendation on Grubhub, wrote out a full-fledged report. It was really powerful. I agreed with it. Some of you guys will know exactly what I'm talking about. I'm not into names. My former student presented his Grubhub presentation to a group of portfolio managers, and the group of portfolio managers tore him up and told him how it wasn't, they wouldn't do it. The company wouldn't make the turn. Wasn't a good company. They didn't think anything was going to happen with it. Make a long story short, my student was putting their recommendation at about $20, $30 a share right after Grubhub went public. And over that next year and a half, the stock ran from 20 to about $150 a share. So all I'm saying to you guys is that these stocks can work. They do work. Not all IPOs do. But Dash might be the same as Grubhub. So it might have some run left in it. But again, I would look. And the reason why I brought that story up is just to let you guys know is that no matter how smart you think the institutional investors are and portfolio managers are, they're no smarter than you. And you don't need affirmation from them to go out and make money in the marketplace. All right? If you look and see what you see. So what's interesting is it wasn't the first time that these portfolio managers actually chewed up a student of mine saying they didn't like any of the ideas they were doing. Only that 2, 3, 5, 6 months, a year later, they actually were buying the same stocks in their portfolio that my students had presented to them. So I'm not saying this. I'm saying this to let you guys know. Stick to your guns. You're learning enough. You know enough. There's no reason for you to start looking for confirmation from other people. And that includes me. Once you start to understand and figure this out, the confirmation comes from when the stock does exactly what you think it's going to do, when you put the money in your pocket, whether it be on the long side or short side. The reason why I can make this statement about DoorDash is I've seen this several hundred times. Seen it. All right, seen how these stocks react, see how they work. So be patient with these, work with them. But again, you have my list. I have a couple more in there, but SEER, DoorDash is on my list. Do I think DoorDash will become a bearish as the COVID vaccine becomes available and people start to go to restaurants? Twin, that's a great observation. And we're starting to see that in what we call the pandemic stocks. We know that some of them have pulled back over the last week or two because, quote unquote, we have a vaccine. That we could actually now see a tail or end to the coronavirus. We're starting to see some light at the end of the tunnel. And that means that maybe maybe people aren't taking as many deliveries as they were because the economy now is back open and people can go to restaurants. So that is something that I would watch and observe. We saw Zoom's pulled back a lot from its highs. And that's because of the fact that we're seeing it into the pandemic. We've also saw this week. And one of the things I should say to you guys, if you're forward looking, please, I know I get redundant, but please be forward looking. This past week, vaccine came out. All right. We're seeing that the vaccine's coming out. They're talking about by June of 2021 that everyone could have their vaccine, and that we could actually be moving back towards a normal economy where people can go out and do things. And lo and behold, guess what happened? JetBlue came to the market and did a secondary offering. All right, they did it last week. They raised more money. Why would investors want to buy that stock now? Why can they raise money? It's because they're forward looking. They're saying, look, if this pandemic's over or close to being over, and JetBlue can even get anywhere back to normal or what it was in terms of flying and so forth, look at the revenue that could be generated. So I'm having a statement here that DoorDash comparable with Uber Eats, like Uber, I believe you have Eat. Uber Eats are chewing up margins from restaurants, larger chains who can afford are looking to option arms themselves with electric vehicles. No question. Some of the companies now are saying, it just might be cheaper for us to actually start doing our own delivery. So that's always, there's competition. And the thing that you got to look at with DoorDash, again, I'm pausing here. The thing that you always gotta look at, and I'm smiling as I say it. My former student Ham is bringing it up, and one of the things that you gotta look at is you gotta be forward looking. And the other thing about DoorDash, ask yourself this: what competitive edge does DoorDash have? What does DoorDash have a moat around it? Can DoorDash stop competition from coming in or dominate a market where there's no competition? And again, I'm not trying to be funny. There's no barrier of entries to DoorDash. There's none. The only thing that DoorDash has over its competitors in certain respects is that they have more people using their service now. So they are the leader in the industry, not because they're the best, because they're the largest. But competition can show up at any time. So, as Ham says, all it takes is a phone and a driver. It really is. And an application which you could actually use the same app that chauffeurs use to network and about where to go and when to pick up and so forth. So it's not an industry that has a high barrier of entry, which means at any time they can get knocked off, which means this company, if the margins stay the way they are and the company's doing well, they're going to see competition. So I guess what I'm telling you, long term, I don't know if this stock's going to make the turn long term. And when I mean long term, 2, 3, 4, 5 years. All right, that's a long term. As everyone's saying, and people are getting what I'm saying, they're not innovators. They're doing something. They built their corporate structure faster than anybody else. All right. And as you guys know, some of these bigger chains themselves are going to say, maybe we just start doing our own delivery. All right, I rambled on a lot here. I do apologize. This is some really compelling stuff going on. I can't speak for you guys, but hopefully you're following everything I'm telling you. My portfolio has been printing green for the last month. It's doing extremely well. I don't see any reason why it shouldn't do. And the other thing I'm going to tell you guys, which I always tell you, is December, this month, is an interesting month. And the reason why I say it's interesting is this. You've got portfolio managers now that are going to do what we call window dressing. They're going to sell some things that they don't want in their portfolio. They might like it. They just don't want people to see it's in their portfolio. So they're going to sell it to move it out. They're going to move some things in. They're going to actually maybe take some capital losses to offset some capital gains. This is the whole portfolio structuring time. So you're going to see a lot of volatility in stocks. You might, and you'll see this volatility move up and down as well as the market, in some cases off of virtually little or no volume. And the reason being is these portfolio managers right now are moving this thing around to adjust their portfolios. It can work to your advantage if you're in the right stocks that they want to put on their balance sheet into the portfolio. They're going to drive the price up. At the same time, if you're in a stock that they're taking profits in, especially a smaller cap stock that doesn't have much volume, you're going to see them move the price down as they start to sell out that position. And the other thing is, and most of you guys know this, when they're buying and selling, portfolio managers are buying and selling stocks that they like, but they want to keep in the portfolio. As you guys know, they got to wait 30 days before they can put it back in. If not, it's called a wash sale and they lose the tax benefits. So all that to say is that this next couple of weeks, you're going to see a whole bunch of volatility. Don't stress. The other thing you're going to see too is you're going to see the market, you're going to see a lot of companies push to try and bring their companies public the last month. Companies that have been hanging around that want to bring their company public this year, they're going to push it. Excuse me. They're going to push them and try and get those deals done. IPOs and secondaries. You're going to see that also year in. Two things, year in, and we're dealing with an up market. So you're going to look and see that. All right, I am out of breath. In fact, I got to take a sip of water. A lot going on, money making time. So just stay with me, bear with me. Ask me your questions. And by the way, please send me your successes. Send me your successes. The one success that someone hit me up on was LAZR. LAZR. Tells you I don't even know the name of half the companies. And what's funny is this was on my radar. I saw the stock when it broke through the $17, $18 range when it ran there. So I actually saw when it ran through the 12, it's on my watch. I missed it. And part of the reason why I missed it, which you guys have heard me say in the past just now, is I don't like small companies in terms of this. And I typically don't trade the biotechs. Now, I'm looking at some biotechs. I've had there's several biotechs this week that have set new highs that were IPOs. And also the other thing too is I got to bring this one up because this stock did exactly what we expected it to do. And the stock is FOUR, F-O-U-R. FOUR went public back in, looks like back here in June. It went public somewhere in I believe the high 20s, opened up at 32, ran. And this past week, the stock did a seasoned offering, and they did it at $62 a share. I think it was 62, maybe 58, somewhere around here. But they did it. And the reason why they did it, again, is like I'm telling you, these insiders, one of the things you want to look for is you don't want them selling stock at the IPO point when they go public. If they're, and by the way, if they're not selling stock, it doesn't necessarily mean the deal's gonna work. It just means that, put it this way, it means that if insiders were selling stock, those make me nervous. And if you look, those are the ones that typically don't do well, especially if there's heavy insider selling. So I looked at this, and here you go, FOUR, F-O-U-R, came to the marketplace with a seasoned offering, which means they started selling some of the stock that they had at the IPO level. They sold it, and again, they sold it up here at the $60 level. So it was a volatile ride, but if you're patient, this is what they do. The model for the IPOs, I'm going to say this, and then I'm going to go. I'll take questions. The model for the IPO is this. The insiders, senior management, the VCs, the private equity guys, they invest in these companies early on. And the way for them to get out of those stocks is to either sell the company or take the company public. When they take the company public, they have the option to sell the stock at the IPO, sell their shares in the IPO offering, which some of them do, or they can wait. If they wait, that's a positive sign for us. The second thing then is that when they wait is that you know that they're going to sell the stock in a seasoned offering sometime in the next 3 to 6 months. All right? That's what they do. So that's when you'll see them start to come out of their positions. And when they do that, they're doing that at a stock price significantly higher than where they went public at. That's why I had that discussion about mispricings. No, I don't believe in mispricings. I believe in mispricings when the insiders sell all their stock at an offering price of let's say $50 or $70 or $30, and they go public at $30, and the stock never trades at $30 and goes straight down. And the insider has sold their stock and started cashing out in the IPO. Those are the ones that make me nervous. Those are the ones I look to get short. All right? Those are the ones. Those are the ones that are in trouble. So you're going to watch your IPOs, watch them. They're going to have a run on them, and then you'll see them do a season/secondary offering. Understand this. When it comes to earnings, the earnings are already in the books. Anybody on this call, which a lot of you are, who are involved in the market like I've been for the past 30 years, knows that the investment bankers, when they start putting out the numbers, they actually have the forecast going forward for the next 12 months, at least 1 year out, maybe two. So they have already understand what the number is they're going to post for the next quarter worth of earnings. Now, we saw that with Snowflake. Snowflake reported numbers. The earnings were a little lower, I believe were lower than what Wall Street expected, but the revenues blew out the number, and their forecast blew out what Wall Street was expecting. Some quick money came out of the stock, and then from there, it ran and ran and ran to the $400 level. So, all that to say this to you. Track the insiders on what they're doing. That's who you want to follow. That's who knows more than we know. As you guys know, they call it asymmetric information. It's one way. They know more than we do. They brought the company public. They're the ones sitting down. They're the ones that understand who's buying the product, who's the services. They understand what's going on with the company better than anybody else. Now, the question came, how can you find out the insiders are selling? This is all information that is inside the prospectus. It's legal information that's inside the prospectus. For those of you who've never read a prospectus, I highly recommend, and they're free information. I highly recommend that any company that you're interested in investing in or trading or that you own, go pull up the prospectus. It's free. You can get it on NASDAQ.com. You can get it from the SEC's website. I'll repeat again, NASDAQ.com. You can also get it from the company's website. And also, a lot of the brokerage firms have a link that if you, like I know TD Ameritrade has it, that has a link that you can actually see the SEC filings. Go in there and read the prospectus. Go just glance through it. You can find out what the insiders are doing, what they're not doing. I attempted to show those in a demo in a previous call. The challenge I have is that my pictures are so small because they're on this Instagram and they were hard to read. But anyone that's ever been in the classroom with me, that when I talk about this knows I will pull up a prospectus and go through it. That's the information. Again, whether you're trading IPOs or not, if you're involved in a company that's went public in the last, year, 2 years, 3 years, pull up the prospectus. Now they go back, all of them have it. The only reason why I say 2 or 3 years is because the information is timely. So after 2 or 3 years, it might become stale. But if you want to get an idea of what the company was all about, what they were doing, go read the prospectus. I read prospectuses. All right. I see it's 10 till, so I'm about to wrap this up. One, because I'm parched. I've been pumped this whole call today. I think there's an opportunity out here for us to make some money, and that's what this is all about. Never forget, my goal behind Wall Street Wednesdays is to help you put money in your pocket. That's what my goal is. All right. I don't see any other questions. I'm looking. And by the way, Airbnb will be on my list to watch. So just what you know, I'm going to do the exact same thing that I'm showing you now. I'm going to look at Airbnb trade. I'm going to watch it trade. I'm going to see where it goes the first 2 or 3 days, watch all that, and then make a judgment based upon if the stock's overvalued, undervalued. And what I mean by that, if the stock, and by the way, before I go any further, one last little tidbit. Anytime an IPO breaks its offering price, it's in trouble. It could be short term where it goes low for a day or two, then runs up. But my experience has been, especially the sooner it breaks it, in other words, if the stock went public and breaks the offering price the first day, they're in trouble. If it happens 2 or 3 weeks from now, they're still in trouble. If it happens 2 or 3 years from now, yeah, you could be some pressure on it, but I'm not sure if the company's in trouble. But if it happens the first day, and I showed you some last week, ADT came to mind, Casper comes to mind. One that recently came public that I forgot about was McAfee Software. McAfee Software was another one. It broke its offering price and went straight down from there. All right, where would I find unfulfilled institutional orders? Now you're asking if you can actually look at a trader's books, and they will not show you their order flow. People like me would love to see their order flow so I could trade around it. They do their best to try and protect the order flow. So I'm not sure if you ever see an institutional's order book. I was getting color on institutional side from the actual investment banker's trading desk. So I'm going back some years. I had an account at Goldman. I had an account at basically every major firm on Wall Street. And the brokers I had understood the kind of business I did. And so I would call them up and say to them, can you call the trading desk and find out what's going on, what they're seeing, what they're doing. And that's how I kind of kept a hold of what was going on the trading desk at those particular firms. And in some cases, and guys have heard me say this, in some cases, depending on who the firm was and my relationship with that firm, I literally might give them my stock to trade for me. I literally might hand it to them. All right, so you said to check the company's prospective. No, it's a prospectus. What you have there, prospectus. And again, go to NASDAQ.com. NASDAQ.com. I'm going to do it as I tell you. I'm checking my time. I don't want to lose this recording. So I'm going to NASDAQ.com. I'm going to tell you exactly where to go to do this. So I'm in NASDAQ.com. All right, let me close that. I'm going to market activities, a pull down window, market activities. I'm opening up market activities. Now, when you open up market activities, under market events, you'll see the IPO calendar. I'm clicking on the IPO calendar, and now the IPO calendar has come up. In the IPO calendar, you have deals that were priced, you have a list of the upcoming deals, and you have the filings. These are companies that just filed. Any of these companies, you can click on the actual name of the company, and it'll open up. Bear with me a second. It opens up now and it shows you an overview, the financial filings, and the experts, their opinion. I'm clicking on the financial filings. And as I click on the financial filings, I scroll down, and you'll see the company filings, the S1, the S1A, and the 424B4. Now, the S1 is the original filing. The S1A, anytime they make a change to the syllabus, anytime they make any changes, they must file an S1A, an update. And then the 424B4 is the final prospectus after they've gone public. Open those up. There's a link to them. Open them up and start glancing through them. One of these Wall Street Wednesdays, I will go through a prospectus and show you the things I look for. Again, my students who have me in class know that I do this. I've done this with them in class where I actually open a prospectus and show them where I read, what I look for, and how I go through it. All right, guys. Let's see. I don't. All right. Let's see. So I'm just typing. Here it is, NASDAQ. Oops. NASDAQ.com. All right, guys, I'm about to sign off. I appreciate you. I'll post this. Stay in touch. Again, come check me out every Wall Street Wednesday. I'm working on some really big things outside of Wall Street Wednesday, which I think is going to put some money in you guys' pockets. So I'm excited about that. Stay in touch. And again, please let me know how your trading's going. Give me your testimonies. And if it doesn't work, tell me that too. Hey, Professor Milligan, what you said didn't work, didn't like it, didn't work for me. Because it's not 100%. Sometimes things don't work the first try, but stay with it. All right, guys, have a blessed one, and I'll see you next Wednesday. Milligan out.